Um, Thank you for joining us. I have with us here today Dugan Kelly from Kelly Clark Law. I've asked Dugan if he would share some of his knowledge on 1031 exchanges and going through the process. We have a lot of investors that we work with that have 1031 exchanges, and there is a process to go through. Dugan is the securities attorney and business attorney and counsel for Think Multifamily, the group that we have a partnership with and provide equity on their projects. And so Dugan's got a lot of knowledge. I've learned a lot from him and asked him to share some of that with all of you. So Dugan, I appreciate you taking your time. I'm going to shut off my video and appreciate you going through this with everybody.
You bet, Eric. It's a pleasure to be here with you. Thank you so much for having me. So this is a great topic of conversation, not just for passive investors, but also for syndicators. But in particular, I'm going to focus in on why this is important for high net worth individuals, people that are looking to redeploy capital, and how they can defray or defer tax on the capital that they get. So I entitled this conversation essentially why multifamily syndicators and, more importantly, passive investors should care about 1031 exchanges. All right. And what you're going to learn today in this short talk, is we're going to talk about instructions. We're going to talk about what is a 1031 exchange. What are the easy rules for 1031? Why are 1031s sometimes so stressful for passive investors? And then, more importantly, how do I use 1031 into a syndication or alongside of a syndication? And what's this funny word that people called a TIC? And what happens if I need to bring debt too? So all of those things you're going to learn today. This is a good talking point for people that have utilized 1031 and people that are actually looking to use it again. A little bit about myself. So I'm the managing shareholder of Kelly Clark. We are a boutique full service firm with a national footprint. We have offices in the Dallas, Texas area, as well as Santa Barbara, California. Represented real estate investors in all phases of the deal. Typically, we're structuring deals in excess of $1 billion on an annual basis. Last year, we did $4 billion. And we also handle litigation for operators around the country when they face challenges in their portfolio. So what is a 1031 exchange? Well, when I say 1031, that's my favorite part of the tax code. And it's a section of the Internal Revenue Code. It's section 1031. It enables a taxpayer. And when you see the taxpayer, I want you to insert in your mind passive investor. It enables a passive investor to sell investment property with little or no tax liability on any resulting gain, preserving the sale proceeds for the purchase of another property. So instead of using the proceeds of the sale of a property and then having to pay a bunch of taxes on that, and then your choices of what properties you could then reinvest into are actually narrowed. This allows you to maintain the full amount of profit, to be able to redeploy that full amount of profit tax-free into another property on the commercial side. And what I think is most important is that this is a most extreme advantage for people that are looking to build wealth. This is what we call a wealth building loophole. If you want to know where the rich are amassing their riches, this is one of the key tools that they use to build generational wealth. So this is a strategy. Let's start right now. This is not a tax waiver. There is no such thing as you never have to pay taxes. This is a tax deferral strategy. This allows you to be tax deferred versus tax free, right? This allows you to exchange theoretically throughout your lifetime and keep the wealth in your family. And then, most importantly, if you're so disciplined that you're able to do this over and over and over again, and you pass away, your heirs inherit what's called a step up in basis, which means that theoretically the taxes that you've been deferring all that time have been waived because your heir has inherited a step up in basis. Capital gains go away at death, and depreciation recapture also go away. and there's no limit on how many times you can do 1031. So you can continue to do 1031 after 1031 after 1031. All right, here are some easy rules. These are easy rules for you to remember. And at the conclusion of this presentation, if you want a copy of this presentation, Eric or any of the great people over at DMI will be happy to provide this to you so you can look at this PowerPoint at your leisure. All cash proceeds from the sale of the relinquished property. That's the property that you're selling. The relinquished property is called the property that you sold, must be reinvested. That you got to take that net profit and reinvest that into a replacement property. If you don't do that, you're going to pay the tax on the difference, meaning the gain that you had. Number two, the purchase price for the replacement property must be at least as much as the sales price of the relinquished property. Or guess what? You're going to have to pay the tax on the difference. Number three, the purchaser of the replacement property, that is you, passive investor, or your entity, must be the same as the seller of the relinquished property, meaning the same taxpayer owned the property that sold, and then you're going to repurchase, you're going to purchase another property under the same taxpayer, or it can be a disregarded entity. Let me stop right here because I get asked this at conferences all around the country. Husband and wife own an Airbnb or something or a piece of land that they have sold, and now they want to utilize 1031 to defray the taxable gains on that. Can they do that? Yes, they can. But more importantly, they say, well, we want, for asset protection reasons, we want to hold our interest in an entity. Now, the entity wasn't the initial taxpayer. The entity is a new taxpayer, and that is called a disregarded entity, meaning it is a limited liability company. A limited liability company is a disregarded entity. So you can have your cake and eat it too. You can own something in your individual name, set up a new entity, treat it as disregarded, and that can be still 1031 compliant. All right, for safe harbor protection. Now, when we talk about safe harbor protection, what we're talking about is safe harbor from Uncle Sam, having to pay Uncle Sam taxes from the proceeds of the property that you sold, the relinquished property. Exchange funds, those funds must be held by a qualified intermediary. A qualified intermediary is a company or an entity that provides you escrow services to provide safe harbor, meaning you don't take possession of those funds. If you take possession of those funds, you're going to be taxed on those funds. So what happens is when you sell your relinquished property, all of the proceeds from the sale of that relinquished property flow into a qualified intermediary's escrow account, and they sit in that escrow account until you tell them, here's the next property that I want to buy. This is the replacement property. And then they wire those funds out to another title company for the acquisition of that replacement property. And you've accomplished the tax deferral strategy with regards to 1031. Number five, you have to purchase what the IRS calls like kind real estate that is intended to be held for rental, investment, or use in a business. All right. Now here you're like, what's like kind? Does that mean if I own a bowling alley, I got to go purchase another bowling alley? Or if I'm Airbnb, I got to go do another Airbnb, or raw land to raw land? No. In fact, what the IRS has said is this like kind definition is extremely broad. So in other words, you could go from raw land to single family, raw land to multifamily, raw land to commercial office, or retail to industrial, vacant land to oil and gas interest, mineral interest, air and water rights, Delaware statutory trust, or what we call TIC, which is which stands for tenant and common property interest. All of these types are like kind, and you can go from one to the other or anyone in between, and it still be 1031 compliant. Now, here is the timeline. So you're thinking, hey, this sounds too good to be true. What's the catch? Well, here's a catch. The IRS has very rigid timelines for which you have to accomplish your 1031 exchange. It's a 180-day time period. And within that 180-day time period, that starts from the date you close on your relinquished property. So day one starts the day that you close on your relinquished property. Your qualified intermediary takes that money into its escrow account, and then you have 45 days to designate replacement properties, potential replacement properties, one of which you have to close on within 180 days. Otherwise, you're going to have to pay the tax. So the exchange timeframe begins the day after escrow closes on the relinquished property. And from this point on, the 180-day count begins. And there are no extensions. So I've been practicing for over 20 years, and I have only seen these rigid timelines being extended one time, and that was during COVID. They actually extended them, but not indefinitely. So I would not count on the IRS making any extensions on any of these time periods. You just have to remember 45 and 180, and you'll be fine. All right. So why are 1031s on your own so stressful, right? So I represent a lot of high net worth individuals, family offices, passive investors around the country. And almost uniformly, when I have conversations with them about what do you think about 1031, the same comments come back to me. And it's like, man, it's hard. It's hard to find properties in the timeline, that 180 days that pencil out. Maybe I live in California or New York, where it may not have deals that will cash flow immediately. And maybe investing out of state because I don't know anybody out of state. Maybe that's difficult, right? So it can be tricky and not understanding that. Working for banks, like if I've got to put debt also into this deal to qualify for the loans is not always easy, especially if I have a W-2 income and I'm going to work every day, right? So it's a catch-22 for part-time real investors. Buying value add properties means lots of work, right? Time and money. You got to rehab the property yourself. You have to manage the subs and all of that after the purchase. And buying turnkey means there's not much equity left in the deals, if any, in markets that might not be appreciating. So that's why 1031 exchanges personally, if you're doing it by yourself, they can be stressful. So I want you to think about another alternative. I want you to expand your mind or creative thought process into being able to do 1031s with other people. And so in this like kind, we have a tenant and common arrangement. So one of the strategies allows you to do this is also called a TIC for short, tenants in common. This allows ownership in which two or more people or entities own separate shares of the same real property. Let me say that another way. Each person holds an individual, what the IRS calls undivided ownership interest in the same piece of property. This allows you to be able to essentially come alongside of a syndicated entity and own your own slice of the apartment building that they're going to market with. And so now you have two owners theoretically of that same asset. A TIC structure may be beneficial for someone who no longer wants to actively manage their real estate portfolio and is looking for income or tax deferral benefits. It allows the average person to have high credit rated tenants as well as geographical diversification, meaning now I'm not just limited by my own ability to scale in the market where I live. Now I can tap into other operators or syndicators, sponsors of deals. Those terms are used interchangeably with one another. I'm able to actually tap into their network and do a deal in Florida or Tennessee or Alabama or Arkansas or Texas or wherever that deal might be that the sponsor, let's say it's DMI, wherever DMI has its eyes are hunting and actually acquire an asset. Now I can tell Eric, fantastic, Eric, you just got an asset in Arkansas or Alabama or Tennessee or Florida. And I'm able to invest alongside of Eric and DMI in this through this use of the TIC. Now, here are the benefits of 1031ing via a TIC alongside or into a syndication. This increases your buying power, first and foremost, right? Because remember my analogy of Airbnb and then the person thinking to themselves, well, now I got to go back into another Airbnb. No, you don't. You can go Airbnb. Let's say you have 500,000, 700,000, or $1 million, and you've got to redeploy that into it. Now you could have a stake of a $30 million apartment complex. Wow. What? You're saying that I could take that Airbnb proceeds and then leverage it up, actually increase your buying power into a larger asset or a different asset classification altogether? Yes, that's exactly what I'm saying. These are passive. These can be largely passive investments, meaning there are professional property managers. There's day-to-day asset managers. So essentially, you're taking away some of the stress of, remember, you have to manage your own portfolio or your own commercial asset. Or when there's complaints, you have to field that from the tenants and actually go resolve that. Well, this takes that off the table, and you're able to have qualified professionals essentially handling that. Diversified markets, right? We don't have to be an expert in every market. The market that we want to be in, we can actually be in, despite us living in a different market. And then you don't need to qualify for financing, right? Because obviously some the debt in the what we call the capital stack is already being arranged by the lead sponsor. The syndicated entity has already negotiated terms, likely with a senior lender, to provide debt, and you're able to take advantage of their negotiations in connection with that. And this dramatically decreases risk and stress of 1031. So if you go from a full recourse product, imagine you had like an Airbnb or a piece of land or office, right? And you had debt on that. That was likely full recourse. Now you're going to a stabilized asset in the non-recourse debt, meaning you have just mitigated your personal risk while able to leverage up into a higher asset classification to increase both cash flow and appreciation. It doesn't get much better than that. All right, so let's talk about the typical structure. So a typical structure in a syndication, we have limited partners or Class A members, and then we'll have Class B members who are also the sponsors. So you might see a 70-30 split, right? 70% of the new entity, and in this case, we're calling this NewCo. NewCo has been set up, and 70% of NewCo is being sold off to passive investors. The money being raised from the passive investors is used to get the debt, the leverage in the deal. And as a result, you get the keys to the apartment building. So this is a very common structure. So now let's take a look at what does the structure do differently? How does it change? And this is how the structure changes. So now we still have a 70-30 split. And in this case, you can see we now have 3 co-owners of the same property. So we have the same analogy. We found a multifamily property. DMI located an apartment building that it wants to buy. It's raising capital. It's going to agree to allow 2 other tenants in common. Both collectively, they own 8% of the undivided interest in the real property. Taylor owns 5% and Tinker owns 3%, which means that the other percentage of ownership is the 92% is actually owned by the syndicated entity, which brings the lion's share of the equity to the table. The asset managers are often the lead sponsors. So the people that actually putting the deal together, the people that professionally have underwritten the deal, that they know the deal, they like the deal, and they're going to operate and run the deal. Those are typically who your asset managers are. And so this is what we would call a tick structure. So now instead of having one entity, which is the syndicated entity, own the real property, we now have 3 entities that own the same piece of real property, and they do so through this tick structure, through this tenant in common structure. All right, so a couple of things to remember. If you're going to participate in a tick, you are co-owners. You're not partners. And the concept in the lingo of 1031, partnership is a bad word, because the IRS says, remember, it does not treat membership interests or shares of stock as like kind, but it does treat ownership interests in real property as like kind. And even your ownership in real property through that disregarded entity, you are treated as like kind and as a co-owner of that real property. So each co-owner holds title to the property as a tenant in common. ownership with the TIC parties will be governed by a TIC agreement. This is it mirrors very similar to like an operating agreement or a limited partnership agreement. And that is between all of the co-owners in connection to the real property. Co-owners are generally treated as passive investors, theoretically, with the sponsors of the project managing the day-to-day operations. That's not uncommon. And sometimes that's required by the lender in connection to the actual opportunity or acquisition of the asset. The lender wants one face, one person to talk to, theoretically, as the point person for all the co-owners. That's typically the sponsors. All right, let's see here. All right, that is... Let me see here. Hang on one second here. Let's see here. All right. So those are the high level. Information that we have in connection with 1031s. And if you want to learn more about us, this is our information. We got a YouTube channel, Facebook, Instagram. But more importantly, I think it's important that you see how beneficial this can be for you in your own portfolio as you begin to look at opportunities that DMI might have for you to be able to actually redeploy that capital in such a way that it benefits you so that you can grow your asset, more appreciation, and better leverage.
Dugan, thank you so much. Just kind of throwing a coin out there for Dugan. Any of you guys that are, Dugan assists us on every one of the projects that we're doing with Think Multifamily, is instrumental in the closing. He's worked with a number of our investors that have done 1031 exchanges. There's a lot of work. This is a great option for some of you, and those of you that are in the syndication business or are in need of a good quality legal counsel. They provide a fantastic service. We love working with them. I mean, they really have just been such a great help in assisting us and our investors in being able to execute on these kinds of transactions. And, you know, Dugan is not only their legal counsel, he's also an investor himself, just like we are on the DMI side. And I think that just goes a long way. And with the 1031 exchange option and the deferral of the taxes, and some of you guys are familiar with it. Some of you guys own property and may not totally understand it. Hopefully this gives you a lot deeper insight. And so Dugan, I just want to thank you for spending your time. And with that, we'll go ahead and conclude.
Great.